Southern California has lagged behind the national norms in 2010, and the Inland Empire has been no exception. Inconsistency has been the big concern in the Riverside, San Bernardino area, affectionately known as the Inland Empire, as demand has fluctuated a good bit, and as a result, operators have yet to pull the trigger on rent growth. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Inland Empire update. Well, like some of you, we just got back from the conference of the National Multi-Housing Council in the Palm Springs area, and so I had a chance to tour the Inland Empire area, and we'll show you some pictures of our trip and seeing some recent completions. There certainly aren't nearly as many today as there were a few years ago, but still some new supply out there. And so we thought what would be more appropriate than devoting an episode of Apartment Market Dynamics to the Inland Empire. Let's start with apartment demand. Inland Empire had some net move-outs in third quarter, but fourth quarter was an on period. 1,220 units absorbed for the year, 4,290 units, pretty solid. Still, it's fluctuated a good bit. And as a result, occupancy has improved on an annual basis, up 1.5 points from a year ago, up to 93.9%. But that rate is pretty much on par with the rate seen in first quarter. Most of that improvement over the past year came in the early part of the year. And over the past 3 quarters, occupancy has held pretty steady, and that's why rent growth here has been pretty muted. Same-store rental rates improved just 0.2% in fourth quarter, and they're up 1.2% year over year. And that's not bad, but it's well below the national norm of 2.3% in 2010. And while there are some positive trends in the Inland Empire, we do maintain some concerns about this one. One of the big issues has been that the Inland Empire apartment market has benefited from a lot of people moving out of foreclosed homes, even foreclosed rental homes, and back into traditional apartments. But that's not a trend that could be sustainable in the long term. A lot of those foreclosed homes have been bought up by investors, so it's very likely that those homes are going to end up back in the renter pool, and some renters who've moved into apartments could go back to the shadow market of single-family homes offered for rent. So that'll be a concern going forward in 2011 and beyond. So let's give you a couple submarkets. We'll give you the best and the worst of the Inland Empire. Let's start with the good. Let's give you the Foothill area. Occupancy there climbed 1.1 points in 2010 up to a rate of 94.6%, while same-store rents climbed 2.6 annually. Not bad, but if that's the best you got, there's not much to boast about. Still, that was a lot better than what we saw in the Coachella Valley. The big story here was rent contraction. Same-store rents plummeted 6.7% in 2010. That is one of the worst sub-market level results seen anywhere in the country, and occupancy here is still pretty soft, just 92%, though that is up 1.2 points annually. So that wraps us up for the Inland Empire. Until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.